This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
All right, everybody, it has been a wild ride for the economy, global bonds, thinking around where rates go from here. We talked about yesterday the 30-year surging to its highest level since 2007. We got some jobs data today, a little bit of softness, so maybe everybody calming down. So we're going to have a great little roundtable because with us right now is Bloomberg News rates reporter Michael McKenzie on Zoom in New York City. And then with a corporate perspective and more, because he's going to stick around for a couple of blocks, is Brad Jacobs. He's founder and executive chair at XPO, co-founder of United Rentals, former chair of United Waste. He's been described as a serial entrepreneur. He's got a new book out, which we're going to get to a little bit later on. But Brad is here in our Bloomberg Interactive Brokers studio. Brad, thank you so much. We're going to have Michael kind of lay out the rate environment, but how much do you listen and follow in terms of what's going on generally when it comes to rates? Because it certainly impacts corporations' balance sheets, potentially.
Well, we pay attention a lot to that because that determines what you want to do with your capital spending. Do you want to spend more? Do you want to spend less? Do you want to invest? So we pay a lot of attention to that.
Well, Michael, come on in on it and then lay it out for us because it's been kind of a wild ride once again when it comes to global bonds here.
Yes, it has, Carol. And I think the story remains people are still trying to work out where is the top in yields, particularly for 10-year yields, which matter a great deal for the U.S. economy. That's the yield that determines mortgages and also helps determine a lot of the corporate borrowing costs. It made a run above 480. A lot of people talking maybe 5%, but it wasn't that long ago. In fact, just a couple of weeks ago when we were talking about 450 was going to be the ceiling. So really, when you talk to investors and bond managers, as I've been doing for the last few days, there's still a sense of shell shock out there.
Yeah, tell us, Brad, if you want to come in here on the logistics perspective. This has got to be such a tough environment to operate in right now with the idea that interest rates are high and going to stay that way for a while. You've got goods demand and the economy seems to be waning. I mean, how are you managing this right now, and how would you describe how the business is doing?
Well, interest rates are higher than what they were because they were low for a while, but I'm an old dog. I remember when interest rates were much higher than where they are now.
But is that an important point? Because we keep saying perspective. I remember working with folks who said, I remember having a 15, 16, 70% mortgage rate.
I remember when high yield bonds were in the mid-teens, and that was normal, and that was for a number of years. And I remember back at United Rentals when Leon Black was on our board, and he... Of
Apollo fame, of course.
One of the first inventors of the junk bond, now then high yield, called high yield. And I remember when it went down to about 10%. He said, we got to get as much yield as high yield issue as much as possible because it's never going to go below here. Of course, it did and stayed there for a long time. So historically, we're not at very high levels.
How do you look at do we stay maybe here? Like how, when you think about running businesses, or we're going to get into, your kind of next chapter, if you will, but thinking about investing, do you think that this is kind of the environment we're going to be in for a while?
It depends. So that in my career, I've never seen two simultaneous things that are going on right now ever going on at the same time. So you've got the Fed tightening, raising rates, slowing things down, possibly inducing a recession. But on the other hand, you have huge amount of stimulus going into the economy. So I was at the Jefferies Industrials Conference a few weeks ago. I saw about 16 or 17 presentations. Half of them had a slide or two about how much money they were going to get from the CARES Act, from the Infrastructure Act, from the Inflation Reduction Act. So there's trillions of stimulus. Naively, I thought that was done. I thought that was a couple of years ago. It's now starting to come up in big amounts. So that's inflationary. Right. And yet you have the raising the rates. So it's this tug of war going on.
Michael, come on back in, because I think Brad brings in a good point, right? When we talk about the amount of money that continues to maybe come into the economy, fuel it, and continue to put pressure on the inflationary side of things, what are the markets telling us about monetary policy and inflation at this point?
Well, he raises a very good point, and I think this is what the market has missed, particularly the bond market. At the beginning of this year, they really thought there was going to be a recession by now. And that hasn't come to fruition. And in fact, the stimulus coming through the Biden infrastructure and other plans is still kicking in. So the key here is that's probably going to keep employment pretty tight, and that's the one metric that everyone's now watching. And until you see employment severely weaken and then suggest the economy is on a recessionary path, bond yields are going to stay high, and they may go higher. And I think inflation is still fairly elevated. It's more than double the Fed's target, so that still has going to take time to come down. But a sticky inflation environment, a resilient economy led by the job sector, and this fiscal stimulus still coming through from Washington, rates are higher for longer.
I'm curious, Brad, do you have a question for our rates guy?
I do. How confident are you in that? What's your level of conviction on that? Because most people have gotten this completely wrong the last couple of years. I remember I was at a trade organization for mostly Fortune 200 CEOs about a year and a half ago, and we voted on the little Slido app of whether we were going to have a severe recession or a moderate recession or no recession, and over 90%.
Sounds like a conference poll, but go ahead.
Yes, and over 90%, well over 90%, said it was either going to be a severe recession or a moderate recession last year. So obviously that never happened. So how confident are you in your prediction?
Well, it's interesting you made that point, Bryce. I was talking to an investor this morning who said he thinks now that rates are at levels where you will get a recession next year. However, he's still, that's his gut feel, but he says, I still got to check that. I'm not confident enough that, we will get a real slowdown. And so therefore, it really, I think the market's it's been saying recession, and it's been caught out every time. I think it's still going to take time for the stimulus to come through and wear off. And I think the other real factor, I think one of the big changes here is that the bond market's always been used to this idea that, if rates go up, something breaks. Nothing's broken. And I think a reason why we haven't really seen anything break outside, of course, regional banks who've now been ring-fenced by the Fed. And that's a very important point, because as long as they stay ring-fenced, that's not going to bleed into the economy as much. But I think the key fact here is you've got a lot of people sitting on 30-year fixed mortgages below 3% who do not want to sell their homes and take out a new mortgage. And you've got a lot of companies that benefited from borrowing at very low rates back in 21 and 2020. And again, you're not going to get that corporate bond hit that we would have got from higher rates. So I think it's a fool's errand trying to predict more than 3-6 months away. There are some very smart people in this world like Jeffrey Gundlach, who I listened to yesterday when he was speaking at a conference here in New York, saying that he thinks employment will really start to fall apart towards the end of this year because layoffs are coming and they're going to be big. I just don't really know. But I think at this point, if the payrolls hold up, if employment holds up, it's going to be tough for this bond market to not be higher for longer.
What chances do you give that we'll have a Jimmy Carter-like stagflation, the worst of both worlds, where we will have inflation, yet we'll also have no growth?
I mean, when I talk to some big investors like Dan Iverson, particularly at PIMCO, it's a tail risk for them. They do worry that wages could kick up later this year and you're going to get stickier inflation. And then once the economy slowly but surely starts to buckle under these high rates, that you will get a more stagflationary type environment. I think that's not the base case. Most people are thinking here, when you talk to them on the street, the economy will slow. We'll probably have a couple of quarters of soft growth, maybe 1% or less. But no one's really calling for a hard landing recession at this point, really. When you dig into it, it just seems to be where we're probably going to muddle through because the fiscal stimulus, I think, is such a huge difference to what we've seen in the last decade. It just didn't really come through after the global financial crisis in 2008. And that's why we just had very low rates for a very long time. The Fed was doing all the heavy lifting. We weren't really undertaking these big stimulus programs that we're now seeing.
All right, so Michael just threw out a few scenarios for us here, Brad. We've got the potential for stagflation, recession, just muddying through it all. What are you preparing for?
All of the above.
All of the above.
So
well spoken.
When you're running a business, you first of all, you have to decide, is your vision high conviction or low conviction? Right now, if you think it's high conviction, then you're not right, because there's a lot of different scenarios here that got to get played out, including geopolitical scenarios. So you have to be prepared for everything. You can't just be paranoid and stop investing and stop growing, and you have to keep investing in the business, but you have to also be prepared for perhaps even a sudden downfall.
What are you most prepared for, though? Is it that idea that we are all too rosy? despite all the stimulus money still coming from some of the spending programs? Or is it, that's what I'm trying to which way? So and just get about 30 and then you're going to come back and talk more.
So I chair 3 companies, and the answer is a little bit different for each company. So in the warehouse business and in the brokerage business, volumes have slowed. There's no question about that. And that's not a new piece of news. It's been slowing for quite a few months, and they haven't bottomed and turned back up yet. They've slowed, and they're staying down the bottom. On the LTL side, which is XPO, that's separate from what's going on in the macro because it's had 2 major events that have benefited XPO, the bankruptcy of Yellow, and then now recently the biggest private company, Estes, has had a big cyber attack, and they're just down.
So that benefits it.
Yeah, sadly, it's a bad thing for them, but it's good for XPO.
Bad news, good news. I want to get back to our guest at this hour. Delighted to still have with us Brad Jacobs, founder and executive chair at XPO. I mentioned co-founder of United Rentals, former chair of United Waste. I was doing some reading, I think we both were, and he's been described as a numbers guy, a serial entrepreneur, and he has a new book coming out, How to Make a Few $Billion. Still with us in our Interactive Broker studio. Great discussion. Loved having you weigh in on kind of these micro data points or moves in the market and how you see it on a bigger perspective. If you had to describe the business environment right now in a word or a handful of words, how would you do it, Brad?
Mixed and uncertain.
Mixed and uncertain. Glass half full, glass half empty, or right at the middle?
Glass
half. Glass half. Well, okay, so walk us through, work it out. Labor market, costs, like what is
Labor market tight.
Still.
Oh, absolutely. Well, it's not as tight as it was during COVID, and no comparison. You can actually find workers.
Right.
But wages are up and trending towards up. But you can find people, for instance, in the XPO business, we can find drivers. During COVID, we couldn't find drivers.
Right.
Just our base core people, but a lot of people checked out and didn't come back.
It's got to be concerning for, I would think, a lot of CEOs right now, looking at all this heightened strike activity. Is there, how would you describe right now, like the labor unrest around the country right now? And is that something that worries you at all?
Well, as a company executive or as a citizen of the country?
Give it to us both, but more the company executive.
As a company executive, no, it doesn't bother me at all because we were the target of a Teamsters national campaign for 7 years. And it didn't work, and they left, and they went on to Amazon, which is a much bigger fish than XPO. So I suppose they're not coming back to us. But even if they do, we work so hard at creating an environment in the workplace where people are happy to come to work and people feel valued and respected. That doesn't bother me.
How do you give them that, though? I mean, there's so much demand right now for, I would think a lot of your workers probably need to be in person, right, for the work that they do. And so much of what people want is remote. And is it more in giving them different hours and schedule flexibility? What can you give to them?
Well, if you're a driver or you're a dock worker, you can't work from home.
Of course
you need to come in. And that's the majority of our workers there. So what you have to give them is respecting them. And really show respect by paying them properly, by listening to their needs, by communicating with them, letting them know what's going on in the whole company and how they fit in, showing them the pride, letting them have pride in the work by, Mario Harek, who's replaced me as CEO, has done an amazing job. He's done a really fantastic focus on making sure we don't damage freight, make sure we deliver freight on time, which are very important things in our business. And those statistics in our company, those metrics have gone off the charts in the right direction.
We have a great function on the Bloomberg, and it's like the supply chain. And it talks about your customers and who are your clients, basically, and who you buy from. But your customers include everybody from Amazon, Apple, ADM, Lowe's, Walmart, Home Depot, so many more companies. And you have a global perspective. Where is, though, the strongest parts of the global economy in your view? And how does geopolitics potentially continue to kind of impact that and change that?
Geopolitics is very important.
China, I think about.
The 2 biggest things are obviously Vladimir Putin and Xi Jinping, who could literally single-handedly, either of them throw a pretty big monkey wrench into the whole world economy.
Yeah.
Those are not insignificant possibilities. Those are not 1% possibilities. So we have to pay attention to that. But we can't be obsessed by that. We can't just be held down and just enamored by just those features. So we just keep trucking along.
But okay, cute, very
Trucking
nice.
along.
But
Brett,
but Brett, in terms of the pushback against the globalization of the economy, and we talk about that being pushed back. Do you see that, guys?
Oh, for sure.
Firsthand.
Yeah. So you mentioned before,
and increasingly so.
No question about that. So you mentioned before some of the customers you have. So I'm privileged to have windows into GXO, RXO, XPO, where we have a whole cross-section of customers
right.
around the whole world. And so you get to see a lot of information what's going on. And you also get to interact with a lot of customers, a lot of boards of customers, a lot of C-suite. There's not a single board in America that's not who has and has had business in China who's not thinking, I need to diversify away from China. It's just the risk is too high. So everyone universally is doing that.
What about the risks in our own political system? Does that crop up? Does that bother you? Does that worry you about what happened this week with the Speaker of the House?
Well, that's the two-party system, and that's been going on for a couple hundred years.
Do you consider it functional?
It's worked for 200 years. I mean, as a global traveler, I certainly would not want to be in any of the countries that have one-party systems. That's the worst. I mean, there's a very repressive, horrible cultures, and this is a country where, despite everyone fighting with each other and calling each other's names and certain levels of dysfunction, we, unlike China, don't have 1 million people in prison camps because of their religion. We, unlike in Russia, we don't have journalists like you. If you criticize the president, you go to jail for 8 years. So, I mean, it's still a great country, a fantastic country.
When we're looking at some of the trends in the U.S. economy right now, I mean, we've been talking about for so long the shift of preferences from goods to services. And I would think from your perspective, that's probably the last thing you would want to hear. You want people to be buying stuff, right?
We are good. All of the three companies I mentioned move goods one way or another. So more goods is better than more services. But for the economy as a whole, that's a normal cycle. Sometimes it's more goods, sometimes it's more services. We're not in the best part of the cycle to be in transportation. But there are specific things that each one of those three companies are doing that are independent of the macro to improve the businesses.
When it comes to transportation, what are the biggest technology trends that you think are going to change it? We talk a lot about AI. We talk obviously about self-driving. Like, what is it that you think is the most interesting trends that are going to shape it for the next, 50 years?
Well, on the GXO side, the warehouse business, where we have 200 some odd million square feet of warehouses, about 1,000 warehouses, it's the automation of warehouses. And you
continuation of it, right?
Yeah, AI-powered robots. I mean, it's very, very sophisticated, futuristic. You can go into a warehouse that's huge, and there's no people there. Well, there's maybe 10 people.
Yeah.
Whereas, 10 years ago, there would have been hundreds of people there. So that's a very, very big trend. On the RXO side, which is a tech-forward brokerage platform, there, when I first hired Mario Harak, who stayed behind at XPO as CEO, but then Drew Wilkerson became the CEO of RXO. When I first hired Drew, we had a vision of automating that brokerage business because it was 100% human.
Right.
Today it's 96% touched electronically.
I wanted to ask you a little bit, Brad, about how the business is doing now in the wake of the Yellow bankruptcy, and what you can tell us. Have you seen on your side? Are you picking up any of their volumes, any of their workers? How has it changed for you?
Not so many of the workers, and that's a real sad part of the Yellow story.
Yeah, that was 30,000?
30,000 workers lost their job. That's not an insignificant number of people. So it's a real sad human element to that. From a business point of view, the whole industry benefited those who didn't go bankrupt, and they got the volume. So that's tightened up the industry. The pricing is up, volume is up, so it's been a positive thing. And I mentioned earlier the cyber attack on the largest private LTL carrier has also increased more volume coming into the market. So it's good news, bad news for certain people, and for others, companies are benefiting from it.
Just got a couple of minutes left. Jacobs Private Equity, your next act. How are you thinking about it? I know you were at the forum yesterday, and you said it will not be a tech company. You don't understand tech valuations. What kind of company will it be? What are you going to be looking for in terms of investment?
It certainly will be a tech-enabled company, because all my companies have used huge amounts of tech. And I think that's very, very important, because that's the major trend of everything that gives you your edge. But my next company, and I talk about this in the book, is what I like to find industries that are large, so hundreds of millions, billions of dollars in size. I don't like to do small industries. So you look at the industries I've consolidated, they've been large industries, big swaths of GDP. I like to find industries where there's enough things to buy at reasonable prices so that I can get accretion from buying those. And I like to be in an industry where I can buy things that I can grow them.
Like?
Well, I'm not going to tell you.
How big is the fundraise? How much do you plan to be?
Well, I'm going to put in $1 billion of equity into the next big thing, and then we'll buy some companies, and then I'd like to build it up to a larger company. I mean, than I've been running. If you look at XPO, RXO, GXO, put them all together, it's over $25 billion of revenue, and I don't want to go backwards.
How to Make a Few $1 billion, just real quickly. Your new book.
Yes.
You're going to have to come back and talk more about it when it comes out.
I would love to.
But what's the premise?
The premise is, I've been doing business for 44 years. The only job I've had is CEO.
Right.
So I made a lot of decisions, and I made a lot of mistakes. So I thought, let me think about what are the stupidest mistakes I did, and let's write those down. And then let's figure out what did I learn from each one of those mistakes, because that was important, the learnings. And then I said, okay, well, despite these significant and many blunders, we still delivered tens of billions of dollars of shareholder value, which most companies don't do.
Right.
So why did we do that? What were the things we did right that are idiosyncratic, that were specific to us? And that's what the book's about.
Promise me you'll come back?
I promise.
All right, great. I love it. Brad Jacobs, thank you so much. How to Make a Few $1 billion. That book is going to be out in January.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Today, some news out of Verizon announcing 4 winners of its second Climate Resilience Prize, and it's an initiative enacted to help scale proven in-market solutions that are focused on mitigating the disproportionate impacts of climate change on vulnerable communities. They award prizes, and this Climate Resilience Prize is really part of Citizen Verizon, which is the company's responsible business plan for economic, environmental, and social advancement. So let's get to it with a voice who knows about the company's social responsibility initiatives. Here with us is Rose Stuckey Kirk, Chief Corporate Social Responsibility Officer at Verizon, on Zoom from Austin, Texas. Rose, nice to have you here with Molly and myself on Bloomberg Businessweek. What exactly does corporate social responsibility mean to Verizon in terms of goals-specific initiatives, and how does it enhance the long-term viability of the company?
Yeah, well, first of all, hello to you both, and thank you for having me. You know, Verizon set out about 10 years ago to create a plan for social, economic, and environmental advancement. And it was all about how do we use Verizon's asset that can accrue revenue to also do amazing things in society to create economic prosperity for all. And we do that across the dimension of digital inclusion, climate protection, and human prosperity.
So, Rose, I wanted to bring in or to mention that one of our colleagues recently wrote a Bloomberg Big Take on how corporate America has made a lot of promises to hire more people of color, and they actually did it. And this must be an area of focus for you and Verizon, underrepresented people. So tell us, how has the diversity composition at your company changed following the murder of George Floyd and this renewed focus on race in corporate America?
So for Verizon, it wasn't that we created a renewed focus when George Floyd was murdered. We have always been focused on diversity and inclusion. Verizon has one of the most diverse board of directors in the country. In addition to that, we have a diverse leadership team. We have huge commitments that we have made since the beginning of times. When you think about when you think about how we run our business. So I just want to be very clear that for us, it wasn't as though we had to go and make commitments. We have just continued to live the values that have always been in place at our company and continue to ensure that we have leadership from the top down throughout our 125,000 employees around the globe that reflects our society and the customers that we serve.
How did any of it, though, change, to be fair, Rose, because of what happened to George Floyd? You guys have had initiatives in place and have been doing it, but I do think it made everybody a little bit more heightened, if you will, even for those that were enlightened, like you guys at Verizon.
You know, I think for those who suddenly realized that we had a race issue in our country, it certainly made them enlightened. For a company like Verizon, who has recognized that there are disparities that exist, there are systemic issues that exist, we recognize that the commitments that we made have to continue no matter what the climate, the social climate, the political climate. We have to remain committed to what I do every day in corporate social responsibility, which is to think about how do we lift people into economic prosperity? How do we address issues in education, issues with small businesses, issues with making sure that people have the skills that they need to compete for the digital jobs of the future. We just believe that we have to stay true to those values no matter what the issues are that we are facing in society. And the $3 billion commitment that we have put into digital equity over the past several years, and the work that I oversee in enabling that, is a perfect example of that commitment.
So tell us about that investment. How does that money get spent, and how do you then, I'm sure there must be some kind of accountability on yourself to make sure that it's actually being spent in a way that accomplishes those goals.
Yeah, absolutely. So with our digital inclusion work, think about it across 4 components. How do we do the right work in terms of building out networks and making sure that there's accessibility for all? How do we ensure that people know how to apply the connectivity that we provide for better healthcare, better education outcomes, better job outcomes? How do we do affordability and ensure that we are providing solutions that are cost effective for individuals? And then how do we do advocacy within our federal government and our state governments to ensure that we have the right policies and procedures that are in place? So when we think about,
No, please finish.
So when we think about our investment in digital inclusion, it's across those 4 dimensions. So the programs that we have in place, like Verizon Innovative Learning, in which we are adopting underserved middle schools across the nation and giving them for free connectivity, data plans, lesson plans, 5G in their schools, building out 5G labs, impacting more than almost 3 million students to date, with the target of 10 million by 2030. Those are the types of programs that we have in place, that we measure the outcomes, that we're spending money on, that we are seeing the long-term implication that has on students' learning and how it's changing their trajectory on the types of careers that they want. The program's 10 years old, and so we can see students who started in middle school who are now out of college, who have pursued careers because of the intervention that we made. So our spin and our accountability is around making sure that we're building out the network in areas that we are ensuring that people can afford it, that people can learn and apply, and they can be a part of the programs that we have in place that enables them to put connectivity into place and in their lives.
Rose, you have a front row seat to all of this, you guys at Verizon. What do you think is the biggest obstacle when it comes to, or continues to kind of fuel the digital divide? Is it just building out the infrastructure component of it? Is it the affordability component? What is it?
I think it's making sure that we are not only building out the infrastructure and removing any barriers, whether they are federal barriers or state barriers that are in place to do that, but that we're also making sure people know how to use the technology. The important thing for us is that 5G is only important if people understand how to utilize it to solve some of the big problems that we have, to use it so that folks have access to connectivity for healthcare, as I just shared, or for education purposes. So I think a part of the divide isn't just that you don't have connectivity, you have to also address the divide issues in terms of application. It cannot exist in a space of, if you build it, they will come. It has to be, if you build it, people know what to do with it, they know how to use it, and they know how to ensure that equality is in place. In the education arena, we cannot exist in a space where we have a zip code-based education, where children 1 mile down the road has incredible connectivity and experiences with digital technology, and children right down the street don't. That is the divide that we have spent more than 10 years addressing, and the commitment that we are making.
Got to run, but great to get some time with you. Rose Stuckey Kirk, Chief Corporate Social Responsibility Officer at Verizon, on Zoom from Austin, Texas. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
What is wrong with you? Why do you feel the need that you got to get somebody all the time?
Well, when you getting got and somebody done got you and you go get them, when you get them, everybody's going to get got.
Yeah, but you're getting the gotters when they didn't do anything to you to get you.
Yeah, but if the gotters get me, I'm going to get my Glock.
All right, that is Medea Simmons. You know the individual well, a successful and controversial character and a key part of the empire that is now Tyler Perry. This story is the cover story, the domestic cover story of Bloomberg Businessweek magazine. And to put it as the story has done, it's something that Hollywood establishment was very slow to warm to, and that is all the world of Tyler Perry. So let's get to it. This story, as I mentioned, is the domestic cover story. For more, let's bring in Bloomberg News Atlanta Bureau Chief Brett Pulley. He's joining us on Zoom in Atlanta. Brett.
Hi, Carol.
Hi. Love this story, and it's just fun to kind of go through. First of all, tell us how it came together, because I'm just curious, how many months or how many years have you been looking to maybe tell this story?
Well, it's it's a great story. It's a great question. I have to tell you, I first met and spoke with Tyler Perry and did a story about 18, 19 years ago. His first film with Lionsgate, his very first film, had just come out, Diary of a Mad Black Woman, and it's really interesting to revisit someone from the time they're in sort of this new evolving stage that he was in, and then to visit him years later and he's a billionaire and hosts Meghan Markle and Prince Harry at his house. That's like their hideaway when they left the UK, and his best friends with Oprah and all these things, and owns a really formidable motion picture studio here in Atlanta. So it's amazing, and it's a long answer to your question. Now, this story we started pursuing a good year and a half ago, and again it was kind of an ongoing thing. I mean, it's a subject I've paid attention to, and serendipity doesn't hurt. Tyler became interested in buying BET from Paramount 3 or 4 months ago, and was outspoken about that, and that didn't hurt. And then BET is a property that I have a long history with. I've written a book about BET, and so all these things kind of play together. And he's a subject who I've been paying attention to for quite some time.
So, Brett, you get at this a little bit in the story here, how Tyler Perry grew up in New Orleans and then came to Atlanta and realized that this is where he wanted to set up shop, and gets a little bit starstruck almost every time he goes down I-75 and, sees his name on billboards directing them to Tyler Perry Studios. Just want to get a sense from you, this isn't the Hollywood Hills here, but, you've been in Atlanta for quite some time now. You're our Atlanta Bureau Chief. What is it, how much of it do you see driving through the city there?
Well, I mean, you see both things. You see Tyler Perry's presence, as you mentioned. You can't, go to and from the world's busiest airport, which is in Atlanta, without seeing those signs off the highway, because it's so relatively close to the airport. And so his presence, is significant in so many ways. And as is the presence of the entertainment and the motion picture business here. I mean, just over the last 10 years or so, since very aggressive tax benefits have been put in place by the state, a lot of film and television is produced here. Practically all of the Marvel stuff from Disney is done here. And a host of programs, television programs and films, and it's interesting because it has prompted a lot of people who would otherwise be in Hollywood to be here in Atlanta, and that's talent. But also, I've been having conversations with people who are in film finance, and some of the big agencies have put offices here, and so it's really becoming a Hollywood West, and Tyler Perry is a large part of that, and certainly the largest personification of that.
Tell us about Tyler Perry, though, and it's interesting as we teased into it. I mean, this is, Hollywood sometimes misses trends and waves, no doubt about it. And they definitely, the Hollywood establishment, as you point out, ignored this individual who wrote, who directed, who produced, who acted, truly the one-man show. What is it that Hollywood missed, and why did they miss it? And tell us how Tyler Perry's just turning how we make content upside down.
Yeah, well, I think what they missed is that, there are a lot of places to look for business and to look for an audience, right? And I think the prism may have been a little too narrow in Hollywood. Tyler recounts some great examples of that. He went to see an executive after he had built an audience with his stage plays around the country, right? At all these theaters and cities around the country, people would, church groups and stuff loaded up on buses, and people went to see these plays. And then he created a great ancillary revenue along, with merchandise and other sales. And so he had made a fair amount of money before Hollywood had discovered him.
$100 million in annual ticket sales, and you say $50 million in ancillary revenue. Go ahead.
So when he finally got a deal in Hollywood with Lionsgate, right, he put up half, they put up half, and he did what has been key to his financial success. He insisted on owning 100% after Lionsgate was finished with those distribution rights. So after however many years, 100% ownership of all of these films goes to Tyler Perry. So, as a result, Tyler owns all 28 of the films he's made. He owns over 1,800 episodes of television. I mean, you talk about a long tail. As distribution platforms change, and we know they keep evolving and changing, who knows what in the world that'll be worth one day.
Right. Hey, listen, I want to, though, go to what you started to say, that when he went to visit a Paramount Pictures executive looking for a film deal, and they said, well, black people don't go to the movies. Well, he has shown them that they certainly do, right?
That's for sure. I mean, all of the films, every film that he made for Lionsgate, I'm not sure about the subsequent ones, but, the lion's share, no pun intended, of his work has been distributed by Lionsgate in terms of motion pictures. They all made money, and they're reliable sources of revenue, and he delivers them on time, and he delivers them under budget. And of course, these are things in a very unpredictable business, I should say, such as motion pictures, that Hollywood likes. And so he has been a reliable sort of production machine for the motion picture and television business.
So, Brett, you mentioned that Tyler Perry's been trying to extend his commercial reach. He's openly said that he wants to buy BET from Paramount. You also mentioned in the story that Tyler Perry's trying to get into streaming. So what's the next big move for him?
And forgive us, Brett, but only got about 25 seconds.
No, that's okay. No, he's certainly interested in BET and has been interested in I guess it's a matter of if Paramount puts the property back on the market. And he has deals with Netflix and with Amazon and is in the streaming world and has some projects coming up in that world with some formidable stars such as Kerry Washington and Oprah Winfrey and Susan Sarandon. So he's still on the hunt for the elusive critical success, but certainly sticking very close to what has made him a tremendously successful guy.
So many great nuggets in this story about how he came to be and just kind of where he's going. Brett, thank you so much. Of course, our Bloomberg News Atlanta bureau chief, Brett Pulley. His book, by the way, on BET is called The $1 Billion Bet, so check that out as well.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, the S&P 500 officially at one point hit oversold territory based on relative strength index. It went below 30, although it did go just above it again, or back above it, I should say, today. This is the world model we live in. I feel like depending on the data flow, depending on the tone, the Fed speak, the markets move on it pretty quickly.
You know, I think we're still in that good news is bad news is good news. Hopefully our next guest, another Carol, will shed some light on it for us.
Well, our next guest does say the markets are oversold. Let's get to it. Our Drive to the Close guest on this Wednesday, Carol Schleif. She's CIO at BMO Family Office, back with us on Zoom in Minneapolis. Carol, good to have you back. How are you?
To be back.
Well, it's good to have you here. You do say the markets are oversold. You're talking about the equity market specifically, or bond markets as well?
The fixed income markets are pretty oversold too. That shoot up towards 5% on the 10-year yesterday was, I get out of the way and let the knives fall where they may sort of move. So you can make an argument that both markets' emotion has been taking and pushing things to the edges.
So when the one hand you're saying things are oversold, and to my ear that sounds like maybe by the dip, but then you're saying knives are falling, so maybe not so much.
Yeah, I think we've had a balanced approach to risk for a very long period of time, and we think we don't necessarily want to be entirely out of the growth camp. You want to have a leg there because there's some really interesting fiscal stimulus that's putting a floor underneath a lot of things in the economy.
We just talked about that. We just talked about that with Brad Jacobs, who's the executive chair over at XPO, that we can't kind of ignore all that stimulus from policy decisions, right, that's coming into the economy now.
Right. And even when you look at the ADP jobs numbers, the large companies were letting people go, but the mid and small size companies are doing really well. And I've been spending a lot of time recently talking to our commercial bankers, and these guys and gals are banking the mid-size companies, and the primary issue that those companies are having is that activity is so strong they can't get employees in. And you saw in the ADP report that mid and small size companies are still hiring. And so there's a lot of underlying strength that wants to be there. It's a little hairy in terms of they have to have really good clean balance sheets and solid cash flows and patience in accessing the debt markets until we figure out where the debt and credit markets until we figure out where that's going to level off. So But on the other hand, there was, especially at the beginning of the year, you had tech run away with portfolios. You had a very narrow market up until May. And so there's a lot of nuance to the market here, and it doesn't help that we've got all of what's going on in Washington on top of it.
So nuance, meaning what? Get ready, everybody, for some more volatility? Is that kind of
I think volatility definitely through end of year, because one of the interesting things is we had been calling for a soft landing last year all the way through the year, and then when the whole rest of the world seemed to come over to our soft landing camp, that's actually when a lot of the potential headwinds stepped up in terms of consumers. There's a lot of things to watch between here and year end. We'll get some good data as equity investors, in particular with earnings starting next week, so we'll have a couple weeks of good data to be able to parse through from the individual companies, and then we'll get into, thankfully, we have at least 45 more days of some more government.
Not like you're counting.
Yeah, and starting with the jobs report, of course, this Friday. And, so you were just saying, this is really interesting here, that when all of these people started joining the soft landing camp, that's when, ironically, the tide started to shift maybe a little bit in the other direction, started to get some of those recession calls creeping back in there. You still feeling confident in the soft landing call?
I think we're saying there's a potential fragility in the market. Things were pretty evenly balanced going in, but we'll be watching really carefully what the consumer does going into the tail end of the year, because we're coming into one of the most important holiday selling seasons. Even though there was a lot of activity this summer between Taylor Swift and Barbie and all of the other still carryover on revenge spending and weddings as far as the eye can see. But so it'll be important to watch that, a lot of volatility, but we do think a lot of that stuff gets sorted out. People start anchoring to a new higher neutral rate, if you will, in terms of a more normalized neutral rate of 2 to 3%, if you will, on top of whatever inflation ends up being. And inflation is moderating pretty nicely. So things are happening the way the Fed wants them to. If the Fed can avoid raising again, and we do think there's risk of a policy error if the Fed tries to raise again, because you've actually, if you look at where the 10-year's gone in the last couple of weeks, it's like one or two Fed raises right there.
Hey, one thing I want to ask you, and I'm looking at the headline on our market wrap at this hour. We've just got about 13 minutes to go. Stocks are at their best levels of the session, and it's led once again by the NASDAQ, which is up about, Carol, 1.5% here. I've got Google up 2.4%, Amazon's up 2%, Microsoft's up 2%. Big tech, once again, leading the way. Investors, when there's a pullback, they come back and buy in. And then, there's always the argument that too concentrated, these names, they've already had their run. How do you see some of the big take, and what's the play and what's the call here?
I think the interesting thing is you've got secular moves going on in terms of the way people are deploying artificial intelligence. And similar to other big technologies, when you had biotechnology first hit the scene, and it was really just a dream in the 80s and early 90s, the first couple of times those industries ran, but they proved to be a real legitimate sort of game-changing industry. And artificial intelligence, lots of people have been trying to figure out how to deploy, writing business cases for it for over a decade, actually. And we're just getting at the point where it's gaining more public notice. And so between that and a lot of the stimulus that's been teed up by the government plans to green the grid, improve our infrastructure, bring manufacturing home or close to home, all of that stuff entails a lot of technology, whether it's artificial intelligence, cybersecurity.
Just last thing here for you here, Carol, before we let you go. What would you say is your biggest conviction call heading into the year end?
Just got about 30 seconds.
I think the biggest conviction call is probably to stay balanced, to keep a toe in some of the large cap equity stocks, but also not be afraid to sit on a little bit of cash and shorter term treasuries to take advantage of those yields. So it's to keep a balanced approach, so no matter what the outcome, your portfolio is durable.
All right, going to leave it on that note. Hey, Carol, good to catch up with you. Carol Schleif, she's Chief Investment Officer over at BMO Family Office, joining us on Zoom in Minneapolis.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.